Hey everyone, and welcome to episode 5 of the Profitable Rental Podcast by Landlord Studio. And we're going to again explore some of the 6 building blocks of real estate profitability to help you maximize and grow your portfolio. So I'm Logan Ransley, one of the co-founders of Landlord Studio. We're a property management and accounting software designed for small to medium-sized portfolio landlords, particularly focusing on the sort of do-it-yourself aspect. And in today's episode, we want to explore how you can leverage the tax code specifically to increase return on investment of your real estate portfolio and achieve financial goals faster. So today with that topic, we have a very special guest, Ryan Bakke. Ryan Bakke is a qualified CPA, owner of MLS Consulting, passionate about sharing his knowledge with real estate investors and aspiring real estate investors as well across the US, and to help them build generational wealth, reach financial freedom. And the first part of that is all about sort of increasing financial literacy, which is really what we're focused on here as well at the podcast. So great to have you here, Ryan. We'll enjoy this podcast.
Hey, thanks for having me. It's awesome to be here today. I love sharing my knowledge about anything financial education, specifically tax benefits, and building generational wealth through real estate. So that's my jam, and I'm ready to chat about it.
Awesome. Love to start with a icebreaker question, just to ease the air. What's your favorite quote and why?
I have a few. So there's an old saying, and I don't remember the exact timing, but it goes something like, if you had 12 hours to cut down a tree, you'd spend the first 10 sharpening your axe. That's where I do think some people run into that paralysis analysis of getting their first deal done. There's a fine line between knowing when to sharpen the axe and when to start cutting down the tree because we're about to run out of daylight, right? I think sometimes people sharpen their axe way too much and just need to start cutting. But really being an entrepreneur or an investor is knowing when it's time to sharpen that axe and when it's time to start cutting down that tree. So that's one of the kind of favorite quotes that I hear a lot, and it makes sense, but then there's also another spin of that, hey, you don't want to spend too much time waiting because there's people out there that are doing the thing. They're failing, but they're learning from those experiences, and they're going to come back. You're never starting at zero. You're starting where you kind of left off. And so, especially right now, a lot of people, they're not even running analysis on properties anymore because interest rates are too high. Hey, the cost of borrowing is too high. Well, if your pencil's down and you're not doing deals right now, if you're not running pro formas, when interest rates come back down and you have buying power, the deals are going to get gobbled up by people who have been in the game throughout this entire time. So
yeah, I love that quote. I was literally talking about this with somebody this morning about how sort of you can read all the knowledge on the internet, but until you actually start practicing and failing and gaining those lessons, it doesn't become an instinct. You never actually really put any of that sort of knowledge that you learn on the internet into practice until you've done a few failures to start with. So you can sit and look at a deal for years and years and years, but you won't really know how to do that until you get stuck in. So
ask me about buying a multifamily property in the Midwest before I bought my first property and then after. And I can tell you just with one deal, what to look out for, what are the issues you're going to run into. And you just get so much experience to where it's really that first deal. It's not even about how much money you're making on it, but the amount of experience and I done this and the sky didn't fall on top of me. And now I'm ready to go and do that next deal. I mean, you just learn so much from going from that analysis paralysis stage to overcoming the hurdle and doing your first deal, because then you start adding bigger figures to it. So I told somebody the other day, the smallest investment that I ever bought was the house that I'm currently in, which is a $240,000 house. And the largest investment that I've ever done year to date is about a $4 million campground. So within 4 or 5 years, I've gone from the smallest house ever to $1 million, multi-million-dollar acquisition. And it all started with that one house.
So tell us a little bit more about that one house. Like, how did you get into it? Why did you get into it? Yeah. What were the motivations?
Well, so when you start off and you don't necessarily have a lot of money, you have to get creative. And so when I bought this first house, I was still actually working at Deloitte, which is a consulting firm. I was a CPA at Deloitte. I was making like $65,000, $70,000 a year. And I learned about, hey, FHA loans, owner occupied, house hack. You can put 3.5% down, live in one side, rent out the other. And what I also learned through the process was negotiating, and especially getting seller credits. So I don't remember exactly where I heard about it, but I found out about if you can get a good property that you know is going to appraise for more than what you have it under contract, you can go back to the seller and renegotiate the contract price. So what I did is I found a property, put it under contract for $230,000, knowing that it was probably going to appraise for $240,000, $245,000, $250,000. And sure enough, I had it under contract for $230,000. It appraised for $250,000. And yeah, easier said than done, right? Whatever. But what I did was I went to the seller and I said, hey, I'm going to give you $250,000, and the bank's happy with that because it appraises for $250,000. But I'm going to need $10,000 of a credit to cover my closing costs. And that was how I bought my first property with little to no money out of pocket, because I didn't even have to pay closing costs, just the down payment money. But then, of course, because I'm a CPA and I understand the tax code, what I was able to do, because my income was below $100,000, and if you're a tax nerd, you'll love this, but I was able to do a cost segregation study on the unit that was above me, and we'll get into that later on the podcast. But I was able to deduct that loss against my $70,000 income, and I was able to save about $5,000 in taxes that year from doing that. And that $5,000 was literally the amount of money that I basically put down on the house, like 3.5% of $240,000. So it was almost like I got to buy my first investment property completely for free when it all was said and done. And at the time, my mortgage was $1,550 and the tenant was paying $1,200. So I was paying $350 a month to live. And I cut out the largest expense that most people have, which is housing. And I learned to live on that lifestyle. So when I doubled, tripled, quadrupled my income, I still learned to live on that lifestyle. And that's how I'm able to, surplus income and kind of build some wealth. So that's how I got started.
Nice. And those tax laws are an interesting thing. I mean, everyone kind of hears about how real estate is a great way to leverage tax laws, etc., to increase profitability. And you being a CPA and practicing in Deloitte, you would have learned a lot about this, obviously, through your career journey. Give us a rundown on, some of the main sort of tax advantages and regulations that investors should be looking out for. And even if they're yet to get into real estate, what are some of those things that they can really take advantage of?
I always tell people the number one most thing from the bat is that real estate income is considered passive income, not earned income. So it's not about how much money you make, but how do you make it? So if I'm a doctor making $500,000 a year, but it's all W-2 income versus I'm somebody that has $500,000 of passive rental income, right away, I'm already paying less in taxes because of how that income is taxed. And then the fact that I'm able to take depreciation and I'm able to write off a bunch of stuff on that income to where I might be paying nothing in taxes on $500K of income, but the doctor, he or she is definitely paying money on that W-2 income. And I learned this at the first CPA firm that I worked at, which was before Deloitte, while I was still in college. And this is kind of my epiphany, like aha moment to get into real estate, is I was doing 2 tax returns one day, and the one return was a married couple that made $200,000 W-2, and the other return was a single guy who owned 20 apartment buildings in Chicago, and he made $400,000 of cash flow from those apartment buildings, but he paid less in taxes than the married couple that made half the amount of money that he did. So not only did he make double the money, but he was also in a higher tax bracket because he was single, but he paid less in taxes. And I asked my boss, I said, how is that possible? And he goes, it's because he invests in real estate. And ever since then, I've been trying to, piece together every single nook and cranny of the tax code for real estate investors to figure out how that happens. And so, number one, passive income, you don't have to pay Social Security, Medicare tax. And then number 2, we'll get into is that depreciation part of it where, you're able to have cash flow hit your bank account, but you're able to tell the IRS, hey, I have a loss. I actually lost money on this on paper, even though cash hit my bank account.
Yeah, so you mentioned a lot about depreciation. It's interesting because I think this is something that is not talked about very often or well understood. And I think a lot of investors kind of get into the game, but they don't really understand how powerful depreciation can be. So why don't you give us a little bit of an, background on depreciation, why it's important, and then that sort of role of cost segregation studies and how that can actually lead into the long-term sort of tax strategy for real estate.
Mm-hmm. So I explain depreciation as the eighth wonder of the world. And it truly, truly is in wealth building, because we tend to know that real estate appreciates in value, doesn't go down. So people are like, depreciation, like, why is the house losing money? But it's actually the IRS's way of assigning a value to the structure and the components of your building, because they truly do lose value over time. Your furniture, your chairs, the roof, like, it loses value over time. And that's how the IRS gives you, deductions for that loss in value over time. And so if you're dealing with a single family rental, it's normally going to be 27 and a half years of depreciation. And if you're dealing with a short-term rental or a commercial property, it's going to be 39 years. So let's just say, easy math, I bought a $390,000 short-term rental. So 39 years, I get $10,000 of depreciation per year. So if my short-term rental makes $50,000 a year, I get $10,000 of depreciation. Well, even though $50,000 hit my bank account, I only pay taxes on $40,000 because I have $10,000 of depreciation. Now, what the cost segregation study does is, instead of taking $10,000 of depreciation every year for 39 years, it front loads that depreciation into the first year. So typically it's going to be about 20 to 25% of the building value. So let's say it's $80,000 of first year depreciation. Well, I have $50,000 of income and $80,000 of depreciation. I don't pay any taxes on the $50,000 of income because I actually have a $30,000 loss. And normally that loss is going to be considered passive. And what we do as CPAs and tax advisors is figure out how we can get that loss to offset other income producing properties, or to go against a taxpayer's W-2 or 1099 income. Because that's another piece of it too, is passive losses will offset passive gains. So we have a lot of clients that they might have 2 or 3 long-term rentals. They sell them, they want to get out because they don't make a lot of money. They go into short-term rentals, use the losses from the short-term rentals to offset the gains from the long-term rentals.
I think this just goes to show how important a CPA is to sort of engage with in that long-term tax strategy and planning as well, because there's a lot of sort of advanced terminology in there that a lot of people just would not absorb or be able to put into practice by themselves. And so engaging in CPA is just going to be, it's going to make that process a lot better, particularly sort of long term. Just a question around depreciation, cost segregation, and the sort of structure of a portfolio overall. There's a sort of debate, among investors whether they should structure it LLC, S Corp, etc. What's your kind of view on this? Looking at the sort of long-term tax strategy, what are the pros and cons of each? Does one sort of entity mean that you can't do other things versus a different structure? How does that sort of play into the long-term vision?
From a tax perspective, it doesn't matter if I own the property in my personal name or a single member LLC. I still get the same tax benefits and write-offs, whether it's owned by me or my LLC. Now, where it gets a little complicated is if I own the property in a multi-member LLC, maybe with a partner or a spouse, where then I actually have to file an additional tax return, and I have to keep separate books and records for that LLC, separate accounting records, separate books and records. But an LLC doesn't change the tax benefits that you can get. Now, I will say one thing, because you brought up S corporations. So S corporations are taking your LLC and making an election with the IRS to be taxed as an S corporation. You do not want to do that with anything that goes up in value over time. So rental real estate should only be held in your personal name with really good umbrella liability insurance, single member LLCs, or multi-member LLCs taxed as partnerships. You don't ever want to hold appreciating assets such as real estate in S corporations or C corporations, because the way that they're taxed is very disadvantageous to people who own property. There's issues when you put the property in, there's issues when you sell the property, and then even owning the property in an S Corp. Because when you're an S Corp, one of the things you have to do is take a salary from your S Corp. And if you have rentals in an S Corp, it's all passive income. So it's not subject to Social Security and Medicare tax. But if you have to take a W-2 from your S Corp that owns rentals, you're taking passive income that wasn't subject to Social Security, Medicare tax that can be offset by other passive losses and converting that to W-2 earned income that you owe Social Security, Medicare, and you cannot offset W-2 income with passive losses. So you never want to own rental real estate inside of S corporations, but S corporations are for service-based businesses. You're going to have realtors, plumbers, accountants, lawyers. They're going to have S corporations for their business, but you're going to want to own the rental property or anything that goes up in value in just regular single member LLC, or like I said, your personal name with really good insurance.
Have you ever seen any disaster circumstances with people making the wrong decisions of, structuring it incorrectly or not putting the right tax planning in?
A lot of mistakes that I've seen people make is based on the lending side of things. So a loan officer, you might have a property in an LLC or a single member LLC, and then a loan officer says, hey, we can't refinance your property because it's in your business, but we can do it if it's in your personal name. And those guys will look to transfer their rental property from their LLC to their personal name so they can get the refinance. Well, if it's in an S Corp, that's actually a taxable event, just transferring the real estate from your S Corp to you as a person. But if you do that in a single member LLC, you're good to go. You can take it out, put it back in. There might be some state transfer tax issues going from personal to LLC, but from a federal perspective, you don't pay any taxes on distributions from a single member LLC to your personal name, but you do if it's an S Corp. And so it just gets into a can of worms, really. And if you take anything away from this podcast, it's that do never own rentals in an S corporation.
I like that. We'll make that a short and we'll put it up on the socials. Do you have any examples of, I guess, how strategic tax planning has impacted either sort of your own real estate portfolio or a client's one? Whether that's sort of documenting out, hey, this is the strategic tax strategy I'm going to follow for the next 10 years, for instance.
Yeah, so I mean, even just me personally, in 2022, I didn't pay any taxes on about $250,000 worth of income in rental real estate. So I had a gain, a property that I sold for a capital gain. I had a passive rental income from short-term rentals. I had a passive income from a other business that I own. And all that combined was about $250,000 of income, right? Cash that hit my bank account. But because I was able to time up the sale and income of part of my portfolio with the purchase of another asset, utilizing cost segregation and accelerating the depreciation, I'm able to use the loss from the new property or properties to offset the income from the sale of the old ones, as long as it's in the same calendar year. And that's where the timing becomes really important, because if you mess up that timing, you're screwed. If I waited to place that property into service in 2023, I don't get to take the deductions against my 2022 income. Where we see that a lot is clients have a portfolio of multifamily or long-term rentals, and they build up a lot of equity because they're in, Texas, California, places where there's a lot of massive appreciation, but the properties are not making them that much cash. So they want to go into short-term rentals. Well, you can strategically sell your long-term rentals. Yeah, you have capital gains, but you take that money and you invest it into short-term rentals, run cost segregations, and use the losses from the short-term rentals to offset your long-term rental income. And you just keep kicking that can down the road, keep deferring the tax.
Nice. And it kind of leads into the sort of role of the IRS. We've heard a lot of sort of mistiming circumstances among investors, but from your perspective, what are some of the things that, the IRS really hates? Like, what are they looking for? What are they trying to trip people up on? And what should people do to avoid some of those sort of circumstances?
Yeah, anytime you drop a loss on a return, so whether that's a rental loss or you have a business loss, especially if it's going to offset a high W-2 or a high business income, that's going to raise like an eyebrow to them. And of course, like all of our clients, all the people that I work with are doing it. It's just, are you doing it the correct way? Are you meeting the requirements in order to deduct that loss? Whether you're a real estate professional or you're utilizing what we call the short-term rental loophole, it's a loss and it triggers a red flag. But if you are properly taking the loss, you have nothing to be worried about, because if you can actually document that you're rightfully allowed that loss, then there's nothing to be worried about.
Nice. And I guess, have you ever seen any sort of circumstances where people do fall into those IRS? It all comes back to that sort of timing aspect, I'm assuming, of how you're sort of initiating your tax planning over time.
It really does come back to bad education on tax preparers. So there's a lot of bad education out there of, hey, it's super easy to qualify for this. You don't really have to do anything. But that's where people get in trouble, because they trust the wrong people versus kind of doing their due diligence to know what's right or wrong. So for example, we've seen returns in the past where you got one working spouse and a stay-at-home spouse, and the working spouse is a full-time firefighter. I've literally seen this, and the CPA is marking that full-time firefighter as a real estate professional, which is not the case, because they're definitely not spending all their time in real estate. They're a firefighter for their day job. And so those are just the type of things that you see and you really hate, because the audit, honestly, the audit rates are so low that people do that all the time and they never get caught, unfortunately. And it's just really bad for the rest of us that are actually doing it the proper way.
And I guess sort of my final question goes into, everything around bookkeeping, keeping records, keeping on top to make sure that, in the case of an audit, you are on top of all these things. From your view, what is the sort of importance of bookkeeping, and what are some advice that you would give to real estate investors around keeping records and making sure that they've got everything they need on file in case of a circumstance like that happening?
Well, I mean, bookkeeping and record keeping is so important, but it's like the least sexiest thing. You don't see Brandon Turner or anybody talking about bookkeeping, but it honestly is like 3 or 4-fold, right? Because first step, number one, is you're going to go buy an investment property and you're going to use your projections of how it's going to perform when you go to buy it, right? So I'm going to estimate this property is going to make 20 grand a year, 25 grand a year. I see people with these very detailed pro formas, but then when it comes to record keeping, they don't even know if they made money or not, because they haven't been keeping accurate books and records. So it's like, how do you even know that you made a good deal if you can't keep books and records? Second part of it is you need to have accurate financials in order to do tax planning. So you can't sit here and want to do the sexy tax strategies and save a bunch of money if you don't even know how much money you're going to save, because you don't even know how much money you're making in order to save. And then the third part of it is, if you have accurate financials, you can actually make decisions about your overall portfolio and how it sits from an equity standpoint. We work with clients all the time to rebalance their equity structure. You might have, I talked to somebody last week, $400,000 of equity in a long-term rental, but they're only making 10 grand a year net income. They'd have to rent the property out for 40 years just to break even on how much they could sell the property and walk away with today. You can't do that analysis unless you have accurate books. And then the last part of it is, in the event of an audit, audits, honestly, it really is a test of the taxpayer's credibility. So if they're looking at your books and records and you said that you were at your property at this date and this time, and then they pull your credit card statement and it shows that you were actually in Europe or you were somewhere else, it diminishes your credibility. The same way keeping books and records, if you have an expense and they're not able to find a receipt for it, or they're not able to find out when you had that expense, it just damages your credibility and you're more likely to lose an audit. But when your books and records are in shape, you got receipts, you got proof for all your deductions, it builds to your credibility, and they're going to more likely believe your position in tax court.
I like that. And I think that's quite a useful way to frame it. And also sort of the importance around it when you're kind of considering all these aspects, including the bookkeeping side. So yeah, I really appreciate your time today, Ryan, and I think there's some good nuggets of wisdom in there that the audience can take away. Where can our audience find more about you, and what social channels are you on?
Yeah, so I'm all social media platforms. It's going to be at Learn Like a CPA. So that's Instagram, Twitter, TikTok. I also have a Facebook group called Tax Strategies for Real Estate Investors. We have 6,900 real estate investors in that group. I'd love to make it 7,000, hopefully here soon. So join that group. You can post questions in there. I do answer all my own messages, so I don't have any bots or VAs. It's me that answers still to this day, so you'll get a response from me, not somebody else. And that's how you can reach out.
Awesome. We'll let everyone know about that, and including that group as well. We've got obviously a lot of members in Facebook groups, and I think it's a great place to learn from other people as well. So appreciate that. So that's all for today in this episode of the Profitable Rental Podcast by Landlord Studio. Absolute pleasure having you on here, Ryan. No doubt people will be able to take some of that wisdom and apply it to their own real estate business. So if you have liked this episode, just give it a share, give it a like, subscribe to our channel as well. Follow us on social media. We will be putting this podcast episode out on all social channels as well. So if you'd like to learn more about tax planning, tax strategy, go check out Ryan, go check out our podcast as well. And make sure you stay tuned for episode 6 of the Profitable Rental Podcast. It's going to be a good one. So until next time, we'll see you then, and appreciate it, Ryan.